Every time the economy crashes, something strange happens. Millions lose jobs, families lose homes, governments drown in debt, entire industries collapse. But banks often come out richer than before. How is that possible? How can institutions at the center of financial disasters not only survive but grow larger, more powerful, and more profitable after the damage is done? This isn't coincidence, it isn't luck, and it isn't simply good management. It is a repeating financial pattern hidden beneath crisis headlines, a cycle built into modern money itself. Today, we're going to expose that cycle. Not with conspiracy fantasies, but with historical cause and effect, financial mechanics, and uncomfortable truths most people never learn in school. By the end of this video, you'll understand why economic collapses often act less like accidents, and more like controlled resets that quietly consolidate power. But first, we need to go back before modern bailouts, before stock market crashes, before central banks became global financial referees. Because this story didn't start in 2008. It started when money itself changed. Originally, banks were boring. They stored gold. They issued receipts. They loaned out real deposits. But over time, something revolutionary happened. Fractional reserve banking became the standard. Instead of lending only what they actually had, banks were allowed to lend multiples of deposited money, effectively creating new money through debt. One deposit could support 10 times more loans. This created rapid economic growth. But it also created hidden instability, because now the entire financial system depended on confidence. If people believed banks were stable, everything worked. If that trust broke even briefly, the system could collapse overnight. To stabilize this fragile structure, governments stepped in. Central banks were created. Deposit insurance was introduced. Emergency lending facilities were built. On paper, these tools were designed to protect the public, but in practice they created something new, a financial safety net primarily built around banks, not citizens. And that's where the cycle begins. Before modern bailouts existed, banks that made reckless decisions simply failed. Bad investments meant bankruptcy. Poor lending meant closure. But once governments began guaranteeing deposits and providing emergency liquidity, incentives changed. Now banks could take bigger risks, because losses would be socialized. This is called moral hazard. When institutions know they will be rescued during disaster, risk becomes profitable. Let's break it down simply. During economic booms, banks expand credit aggressively. They profit from interest, fees, and asset bubbles. Executives collect bonuses. Shareholders enjoy soaring valuations. But when the bubble bursts, losses are transferred outward, to taxpayers, to governments, to central banks. This isn't theory, it's repeated history. Every major financial crisis follows the same early stage. Step 1. Cheap money. Central banks lower interest rates to stimulate growth. Borrowing becomes easy. Debt becomes attractive. Asset prices begin rising. Housing booms. Stock markets surge. Speculation increases. Banks aggressively lend, not cautiously. Why? Because profits come from volume. More mortgages. More business loans. More leverage. At this stage, banks look brilliant. Balance sheets expand. Stock prices soar. Public trust increases. Politicians celebrate strong economic growth. But underneath the surface, risk quietly builds. Loans become weaker. Borrowers become more stretched. Asset prices disconnect from real economic value. And yet banks continue pushing credit, because the incentives reward expansion, not stability. Eventually, the system reaches a tipping point. Interest rates rise. Debt becomes harder to service. Asset prices stall. Then panic begins. Borrowers default. Markets fall. Liquidity dries up. Suddenly, the same banks that fueled the boom now face collapse. And this is where the pattern becomes truly visible. Because instead of allowing widespread failure, governments step in. During crises, emergency policies are activated. Bailouts, emergency loans, asset purchase programs, liquidity injections, debt guarantees. These measures are sold as saving the economy. But look closer at who receives the first and largest assistance. It's not households. It's not small businesses. It's major financial institutions. Banks receive capital injections. They receive near-zero interest loans. They receive government-backed guarantees. Meanwhile, average people face layoffs, foreclosures, inflation, and reduced public services. Here's the critical mechanism. When central banks inject money during crises, that money enters the economy through financial institutions first. Banks gain access to cheap capital before prices rise. They can buy assets at discounted crisis prices, stocks, real estate, bonds. By the time stimulus reaches the general public, asset prices have already rebounded. This phenomenon is known as the Cantillon effect. Early receivers benefit most. Late receivers pay higher prices. And banks are always first in line. During the Great Depression, thousands of small banks failed, but major institutions with political connections and government backing survived. After the collapse, banking regulations consolidated the industry. Smaller competitors disappeared. Surviving banks gained larger market shares. Crises act like financial forest fires. Weak institutions burn away. Power concentrates in fewer hands, and those survivors emerge stronger. Before 2008, banks expanded mortgage lending aggressively. Risky loans were packaged into securities. Ratings agencies stamped them as safe. Profits exploded, then the housing bubble burst. What happened next? Governments and central banks stepped in with trillions in emergency support. Major banks were rescued. Executives kept bonuses. Shareholders recovered losses. Stock markets rebounded. Meanwhile, millions lost homes. Middle-class wealth collapsed. Public debt skyrocketed. And afterward, banking industry concentration increased. The biggest banks became even bigger. Too big to fail became even more powerful. Here's the uncomfortable truth. Economic crises don't destroy the financial elite. They reorganize at each collapse. Eliminates smaller competitors, transfers assets cheaply to large players. Increases government dependence on major banks. Strengthens centralized financial control. Instead of breaking the system, crises refine it. This isn't accidental design, it's structural consequence. Because when money creation, crisis management, and political power become intertwined, bailouts become unavoidable. Governments can't allow total collapse. Banks know this, and markets price this expectation in. During emergencies, fear overrides scrutiny. When economies collapse, people demand fast solutions, and policymakers respond with urgency. Stability at any cost. Save the system. Prevent total collapse. In crisis mode, long-term consequences are ignored. We accept inflation. We accept debt expansion. We accept bailouts. Because collapse feels worse. But every rescue builds future instability. More debt, more leverage, more dependence on central banks, which sets the stage for the next crisis. When the news cameras turn away and markets stop free-falling, most people assume the crisis is over. But that's when the real transformation begins. After every major financial collapse, governments and central banks enter what they call the recovery phase. This period is presented as healing, rebuilding, and stabilizing the economy. In reality, it's the phase where long-term power structures quietly shift. Public debt explodes. Central banks expand balance sheets. Emergency programs become permanent policies. And banks once again position themselves at the center of the new system. Let's look at what actually happens after a crash. To prevent total collapse, governments borrow heavily. They issue bonds. They expand deficits. They inject stimulus. But who buys most of this new government debt? Banks. Financial institutions earn interest by holding government bonds, effectively turning public crises into long-term revenue streams. Even more important, central banks often purchase this debt directly through asset-buying programs. This creates a feedback loop. Governments spend more. Central banks create money to fund it. Banks manage and distribute that liquidity. Asset prices inflate. Wealth concentrates upward. The public hears economic recovery. What's actually happening is structural financial dependence. Governments become tied to low interest rates. Markets become addicted to stimulus. Banks become indispensable intermediaries, and the system becomes harder to reform. After every crisis, politicians promise reform. New regulations, stricter oversight, never again policies. But history shows these fixes rarely address the core problem. Why? Because the core problem isn't bad behavior, it's system design. Modern finance is built on debt-based money creation, centralized credit control, asset-driven economic growth, financial sector, political influence. Regulations usually target surface-level symptoms, risky products, capital requirements, reporting rules, but they rarely change who controls money creation, who receives emergency liquidity first, who benefits from asset inflation. So while regulations grow thicker, the underlying incentives remain the same. Banks still profit from expansion. Crises still trigger bailouts. Power still concentrates. Here's another mechanism most people don't realize. When governments and central banks flood economies with money after crises, they quietly rely on inflation to absorb the damage. Inflation reduces the real value of debt. It erodes savings. It raises asset prices. It shifts purchasing power. And once again, those closest to new money benefit most. Banks can adjust quickly. Large investors hedge. Asset holders gain. Meanwhile, wage earners and savers fall behind. This turns inflation into a hidden crisis tax. No vote required. No public debate. No visible legislation. Just silent purchasing power loss. Post-crisis environments almost always lead to ultra-low interest rates. This is framed as helping borrowers and stimulating growth. But it also creates massive advantages for banks. Low rates allow banks to borrow cheaply, leverage heavily, invest in higher-yield assets, profit from spreads. At the same time, low rates push investors into riskier markets, stocks, real estate, speculative assets. That inflates asset bubbles, which benefit financial institutions managing and trading those assets. Once again, the system rewards scale and financial access, not productive labor. During the global pandemic crisis, governments and central banks launched the largest financial intervention in history. Trillions were created. Markets crashed briefly, then surged. Stock prices reached record highs. Real estate prices exploded. Wealth inequality widened dramatically. Small businesses closed. Workers faced inflation. Household costs rose. But major banks and investment firms posted massive profits. Their pattern repeated. Emergency money entered through financial markets first. Assets inflated. Those already holding capital gained the most. Here's the deeper problem. Each rescue makes the next crisis more likely. Why? Because every intervention increases debt levels. Market dependency on stimulus, asset bubble size. Central bank balance sheets. This creates fragility. Markets stop pricing risk accurately. Speculation increases. Leverage rises. The system becomes bigger, but weaker. So when the next shock hits, even larger intervention is required, which accelerates the cycle. And this isn't just about banks and markets, it affects entire countries. Developing nations borrow heavily from international financial institutions. They take loans to stabilize currencies, fund development, and manage crises. But those loans often come with conditions. Austerity measures, privatization, reduced public spending, market liberalization. Local populations suffer. Meanwhile, global financial institutions earn interest and expand influence. Debt becomes geopolitical leverage, and financial power replaces traditional colonial control. On the surface, modern economies look stable. Markets function, banks operate, digital money flows smoothly. But beneath that surface, debt levels are historically high. Central banks hold massive assets. Asset bubbles remain inflated. Household purchasing power weakens. The system isn't stable. It's artificially supported, like a structure constantly reinforced with emergency scaffolding. Eventually, the weight becomes too heavy. No one knows the exact trigger. It could be rising interest rates, government debt defaults, currency instability, market crashes, geopolitical conflict, banking sector stress. But the pattern suggests one thing. When the next crisis arrives, the response will likely look familiar. More liquidity, more bailouts, more stimulus, more inflation. And once again, financial institutions positioned closest to the money pipeline will benefit first. Economic collapses remove weaker players and concentrate power in fewer hands. They aren't random disasters. They're reorganization events. Who receives new money first matters more than how much is created. Banks and financial institutions consistently receive early access, giving them structural advantage. Modern economies run on expanding debt. As long as debt remains the foundation of money, cycles of boom, collapse, rescue, and consolidation will continue. Here's the uncomfortable question. If every crisis makes banks bigger, governments more indebted, and citizens weaker. Is the system actually broken, or is it functioning exactly as designed? Not designed by one person, not controlled by one secret group, but shaped by incentives, power structures, and financial architecture that reward consolidation and dependency. The danger isn't collapse, the danger is normalization. When emergency policies become permanent, when inflation becomes expected, when bailouts become standard. Because at that point, crisis stops being an exception and becomes the business model. If you found this breakdown valuable, don't forget to like the video to push this topic into wider discussion. Subscribe for more deep dives into money, history, and financial power structures. Share this with someone who still believes banks just get lucky after crises, and remember, the more people understand how the system works, the harder it becomes to quietly repeat the cycle. Stay informed, stay curious, and question the financial narratives you're told.